The Silicon Valley Bank has been the talk of the town lately. A bank whose name none of us had even heard until yesterday is wreaking havoc in our lives. There have been talks about a recession in the near future. So-called experts are predicting that companies will be dying, jobs will be gone, there will be high-scale inflation and all things scary. All because of this one bank, the Silicon Valley Bank. No matter what happens in the world and the economy, we at Upsurge won't ever stop updating you with the latest happenings in the world. So here we are with a super simplified explanation of the Silicon Valley Bank crisis and our views on whether it will lead to a recession or not. So make sure that you watch the video till the end. To begin with, the entire world is in a panic mode because the Silicon Valley Bank has failed. Yes, failed. Its assets aren't enough to cover its liabilities, and so the bank has shut operations. Now we all know what happened the last time a major US bank collapsed. It triggered the dreadful 2008 recession. So the fear in people's mind is actually pretty valid. But what and where is this Silicon Valley Bank? Is it even big enough to bring the world to a standstill? Let's dig a bit into the bank first. Headquartered in Santa Clara, California, the Silicon Valley Bank or SVB was an American commercial bank that was founded in 1983 and was supposedly started over a poker game between Bill Biggerstaff and Robert Medeiros. SVB was particularly known for being the bank of startups. All VC-backed companies used to park their deposits in SVB. They later expanded to banking and financing the venture capitalists themselves. With their primary customers being startups, SVB soon got into providing debt capital to the same venture-backed high-growth companies so that they can retain them even as they mature from their startup phase. Over the years, SVB became a renowned name in Silicon Valley. So much so that the bank was the 16th largest bank in the United States as of 10th March and the largest bank by deposits in Silicon Valley. Its total assets at the time of the collapse were worth $212 billion. So yes, the bank was indeed significant enough to bring an impact. So what led to the collapse? Well, not anything specific, but a rather series of events. Well, it all started with the funding boom of 2021. Startups were getting funded in millions and they of course deposited those funds in the bank. This was a period of huge inflow for SVB. As a result, their deposits jumped up to $189 billion. However, SVB could not match the increase in deposits with a subsequent increase in loans. So in order to make the most of the accumulated deposits, SVB invested a substantial amount in government bonds. This was at a time when Fed interest rates were low and therefore bonds gave a good yield. This is in fact a common practice in banking. The bank kept a small portion of deposits in hand and invested the rest to earn a good return. But then came 2022 and the Federal Reserve hiked interest rates incessantly. The inflation rate in the US was record high and the only way to tackle it was by increasing interest rates. Now, for the unaware, there lies an inverse relationship between bond price and interest rates. I know it may seem illogical at first, but hear me out. Let us take a $100 zero-coupon bond as an example. It is important to know that a zero-coupon bond does not give interest explicitly, but rather the difference between the price at which you buy it and the original value of it is your return. So if you buy the bond at $95 currently and later on sell it for $100, then that means a $5 return or a roughly 5.26% return. Now suppose the Federal Reserve increased the interest rate to 10%. Doesn't it automatically undermine the value of your bond? When one could get a 10% return, why would he or she want a 5.2% return? Well, to attract demand, the price of the pre-existing bond, the one you bought at $95, would have to decrease enough to match the new rate of return. In this case, the price would drop to $90.9, translating to a 10% yield. So if you were to sell this bond today, that is before the maturity period, you will only get $90.9 in exchange for it, as compared to the $95 you paid for it. Now that we understand the bond and interest rate play here, let us get back to SVB. As the Fed continued to keep on increasing the interest rates, the value of the bonds held by SVB kept on falling. coupled with this came the funding winter of 2022. Startups were finding it hard to raise funds, and so they began to withdraw their money. And as mentioned before, since SVB had most of its deposits in the form of government securities, they were now forced to sell them in order to cater to the rising withdrawal demands. SVB sold a $21 billion bond portfolio consisting mostly of US Treasuries. But this also meant a whopping $1.8 billion loss for them, simply because the bond value had declined. Now, in order to cover up this gap, SVB decided to have a capital raise worth $2.25 billion in common equity and preferred convertible stocks. Things were still manageable at this phase, but then SVB released a press statement with the same details as above that spooked investors and startups. The mention of loss in that release indicated that all wasn't well. Plenty of SVB clients pulled their money from the bank on the advice of venture capital firms such as Peter Thiel's founder fund. On the other hand, the collapse of Silvergate Bank acted as the final nail in the coffin for SVB. Silvergate was a cryptocurrency bank that announced liquidation on the same day as SVB issued a press release. While the reasons for this collapse vary vastly from those of SVB, the investors garnered a general notion that all banks are facing a liquidity issue. What happened next is a classic example of a bank run. A bank run occurs when large groups of depositors withdraw their money from banks simultaneously based on fears that the institution will become insolvent. And before we knew it, FDIC, or the Federal Deposit Insurance Corporation, announced that Silicon Valley Bank is shut down and placed under its receivership. And since then, the startup world has gone into a frenzy. As mentioned earlier, SVB was a bank for startups, and there are still so many of those who have millions of dollars of deposits in SVB. This means that their working capital, the money with which these startups were supposed to carry out their daily operations, pay the suppliers, pay the workforce, has gone down to zero. It is indeed a scary situation to be in. However, the US government had announced that it would guarantee all the deposits at SVB. So the situation may be in control for now. Moreover, it's not just the US startups that are impacted. 60 Y Combinator-backed Indian startups have more than $250,000 stuck in accounts with SVB. What happens next is yet to be seen. But the multiplier effect of this collapse seems to be strong. After the 2008 financial crisis, SVB is the second largest bank to fail in the US Washington Mutual, whose collapse triggered the 2008 crisis and was worth $307 billion at that time. While SVB's assets stand at $209 billion, the nature of its clients may begin a multiplier effect. It may seem that all of this was just a series of unfortunate events that led to the multi-layered collapse. However, shortcomings from both sides, the bank and the startups, are what have put the economy in jeopardy. Firstly, while investing the deposits of its clients, SVB did not take into account the interest rate risk. Even when the Fed had just begun increasing the interest rate, they could have moved the funds to higher yield securities. The loss could have indeed been minimized. Secondly, the startups seem to have been over-dependent on SVB. A prudent financial decision would have been to diversify the exposure to multiple institutions, especially when your entire business depends on that money. Because of the culmination of all these factors, the coming few weeks are going to be challenging for the entire startup ecosystem. And the stock markets may also show some volatility. But despite all this, experts believe that SVB's assets compare to nothing when it comes to large banks like JP Chase and Bank of America. And the US government has also been swift in its action by stepping in before it's too late. So whether this collapse translates into a full-fledged recession or not cannot be predicted right now. We will have to wait for new facts to unfold. But no matter what happens, we promise to keep you updated with everything. If you found the video to be knowledgeable and it helped you clear your doubts, then do share it with a friend. Also, don't forget to like and comment. It helps the algorithm work in our favor.